If you can be able to master supply and demand, you will be able to trade with a large institution, find big risks to the world trade, and bank consistent profit. On this part 1, I'm going to share some vital points about institutional supply and demand that most people simply don't know. And it's these vital points that has actually helped most of my members achieve consistency and profitability and get their first ever profit split. This video will explain what is supply and demand, how to read institutional order flow, how to mechanically draw the zone, how to find high probability institutional zones, and I'm going to drop a very key and important one, which is how to enter and exit them for maximum profit. Does price fall from here to there because there are more sellers? No, this is wrong. Keep watching to get the truth. We always have millions of market participants putting millions of orders in the market for millions different reasons. And these orders they put drive what they call order flow, and this order flow brings price action, and this price action now creates patterns, which is actually what we trade. These patterns repeat themselves regularly, and this allows us to make high forecasts of where price can go to in the future. When these big institutions get into the market, they cannot hide their order flow. Their order flow are being printed on the chart, and you can be able to spot their footprints if you actually know what to do, which is actually what I'm going to teach you on this video. Currency prices move up and down as a result of supply and demand from currency speculators. No trade can take place unless the buyers and sellers agrees on a price, thereby where the buyer will actually demand for the currency by putting the upward pressure in prices, while the seller will actually ask for the price by putting a downward pressure on price. This is an example of how an order book would look like on a liquid instrument where you have both buy and sell sides of orders stacked into the market. So on the buy side here, you're going to see that these are all the long positions that are in the market, while on the other side, these are all the sell positions that are actually into the market. So all these positions are orders that are actually into the market. If you are a buyer, it simply means you are at the bid side of the order book, and if you're a seller, you are actually at the ask side of the order book. And you have to remember, a trade cannot take place unless the buyer and the sellers agrees on a mutual deal. So to execute an order, it must be paired with an order of equal size. For example, to sell 10 lot, there must be a buyer who is willing to buy it at the ask price, and vice versa. So what people don't know is that there are two types of orders. We have the passive and the aggressive orders. So passive orders are when you're trying to enter at the limit order. This is an example of how the passive order will look like. Why we have another type of order which is known as the aggressive order, where you are just trying to instantly buy or sell into the market. You're just trying to enter at the available price by buying at the available price or selling at the available price. And to do that, you have to cross the spread to buy at the ask price or cross the spread to actually sell at the bid price before your trade can go into profit. Imagine this was an order book for euro dollar, and a large institution wants to buy 10,000 lots worth of contract at the current market. This is known as an aggressive order because it's just entering directly into the market. So this order has to be filled at the available ask price, and if the available ask price is not enough, it is actually going to consume all the other prices until when that 10,000 lot is filled. And when this 10,000 lot is going to be filled, there is going to be an overwhelming imbalance between supply and demand, and the price is actually going to gap and go where that order was fully filled into the market. So when the entire order is going to be filled at 1539, then the market is actually going to be deemed to what is known as fair value between the buyers and sellers, as price keeps going up seeking for liquidity to fill the entire order that was actually placed. Institutions cannot hide those huge imbalances that they cause in the market. So if you can be able to identify those institutional footprints on the chart, then you'll be able to trade with the order flow rather than getting smashed against it. So how can we identify this institutional footprint on the chart? You can see how price is impulsively pushing up, liquidating more available supplies to fill in the demand in order to push price further. Why in the opposite direction, you can see how price is aggressively pushing downward, liquidating all the available demand levels in order to fulfill the supply of the institution. These massive moves are being caused by the institution, which is what I'm going to be showing you throughout this program. Now, if we have seen how these zones are being formed or how this massive push are been happening in the market, how can we now do to identify them on our chart? That's where supply and demand zones now come into the picture, which is actually the main topic. Now, how do we identify these zones? When the market is actually moving, you see it moving from one supply zones to the other. This is an example of how the market flow looks like when it's accumulating. It's always at the discount pricing. I also have the premium pricing, which is where we look for supply. So demand are at the discount, premium prices are for supply. So for us to actually know how to spot a demand or a supply zones, we simply want to see price either at the premium or at the discount level, and when price actually shoot out of the range, thereby due to the overwhelming imbalance between supply and demand, and when it gap now into the upside, we want to see price now returning now to the zone. And when it's returning, we don't want to enter because we can easily take a loss. We want to buy now when it has dropped now to the discount of the range, and we continue up, because that massive push to the upside was the institutional footprint that was actually injected into the market. So wonder when price return there, we should be able to enter and follow the other move, follow the move. So trying to sell when the demand has expanded is very, very risky. So you always want price to return to the institutional level before you actually inject a high volume into the market. The exact opposite when price is actually in a bearish scenario, where price will be in a range after sellers will now cause an overwhelming imbalance between supply and demand, and price is actually going to break out of the range. They were expecting price to return to the range and continue down. So in a layman's way, for supply and demand, at a minimum, you must identify a range: initiation, mitigation, and continuation at the minimum. And it's that continuation that we are trying to trade in line with the institutions and continue with the order flow. So, and here is an example of how the order flow always be in the market will be an accumulation markup, the accumulation markdown, accumulation markdown, the accumulation markdown. So the market is always pushing. When it reach an overwhelming imbalance between supply and demand, and the demand is exhausted, it's actually going to now turn and go to the downside. So here you can see how price rapidly initiate down, thereby causing an overwhelming imbalance between supply and demand. It's more likely that this zone was formed by institutional supply levels, and you can see how price is coming back, repeating and testing all those levels. So those levels are all the institutional move, and those institutional move is not going to last. There's a time when the market have overextended and reached at a discount, the market will actually switch, and you see now the institutional move is actually going to change the direction. So our objective is to identify this massive overwhelming imbalance between supply and demand and wait for price to test them and for us to trade in favor of it. So how do we mechanically draw supply and demand zone in the same way every single time? There are three types of supply and demand zones, and I'm going to let you focus on only two, which is range and pivot. The fractal one is completely optional. So a range is when the market actually accumulate and later on break to the downside, or accumulate and expand to the upside. While a pivot, you want to focus on the last opposite candle or a sharp candle that leads to an expansion to the downside or to the upside. Those are the two examples we need to focus on. So basically, pivot, you can use the last opposite candle, while on range, you have to take an entire consolidation. If you can focus on these two criteria, it is actually going to help you to be able to mechanically identify your demand and supply zones in a unique way every single day and every single time you approach the market, which is something you really need. And that is why you have to pick any of these approaches which I have listed to you. The fractal one, I'm going to talk about it, but it's not that too important for you to use as a developing. You must focus either on the range or the pivot levels. So use them every single time so that you can have a unique way of approaching the market, so that your edge can be able to play out in a long period of time. You need to also know that a range zone can be refined to a pivot zone, or it can even be refined to a fractal zone. These are things we are going to actually cover in the upcoming topics of institutional supply and demand, where we're going to be teaching you how to better refine your zones. Refining a zone will actually gives you more winning percentage and high risk to reward ratio in the market, but it's actually going to lead to more missing trades. I always recommend you use the pivot zones, which are also known as the sell to buy and the buy to sell week, which is what most of the students in my academy also use, as that gives you the best balance between trading within a range and within a pivot or within a fractal level, as it's also going to give you a better results in the long run. You also need to know that if you see a range created zone on a lower time frame, it is actually going to be a pivot zone on a higher time frame. This is basically because the higher time frame actually is very, very big, and the lower time frame is actually small, just like what we were teaching you on multi-time frame analysis, where we were telling you that if you can understand the fractal nature of the market, you will be able to actually merge two or more pictures together to be able to perform an analysis. So a range on a lower time frame will actually be seen as a pivot zone on the higher time frame. The same as a pivot zone on a higher time frame can also be seen as a range on a lower time frame. I also made mentions of fractal supply and demand levels. So even though I never encourage you guys to use it, but some people will find it as the best for them to use. So here are examples of fractal supply and demand levels. The first is an inside bar. This is basically when a candle fails to trade above or below a zone. So this type of zones are known as a demand or a supply level on the lower time frame. Then we'll have the second one, which is known as the sell to buy wicks. So if you can see levels like this on the higher time frame, just know that they can also be identified as a range on the lower time frame. Then we have what they call the large wicks. These are actually another form of pivot level where the market aggressively reject a level, and you are trying to actually take the wick. So if you go down and look at that wick on the lower time frame, most often than not, it's actually going to be a lower time frame sell to buy level or a lower time frame range. So these are things you need to take note of when it comes to identifying fractal demand and supply levels. If you go and spot most of these levels, you actually realize that most often price usually tests these levels and react, and you'll be wondering that, okay, why is price reacting from here, without you actually knowing that it has actually mitigated either a fractal demand level or an inside bar demand level or a sell to buy weak demand level before reacting. So it's always advisable to trade, even though I don't insist that you trade from such zones, it's always advisable to plot them to anticipate early reversals, thereby looking for change of characters and other things which we taught you on market structure. And if you have not seen the market structure video, you should consider checking the market structure video so that you can learn all those informations there for free. Everything you need to learn about market structure or to learn about Forex is actually in this channel. You just need to take your time. If you're a beginner, you learn everything right from the beginning, and it's actually going to help you improve your day trading skill. And if you feel asked to go in for a mentorship program and you don't know the best mentorship to go for, I have a very cheap and affordable mentorship for you. You just need to check my WhatsApp number at the description of this video or join any of our social platforms. Then you'll be able to actually get all those informations and enroll to a best quality mentorship at a very, very good and affordable rate, which will actually help you to easily achieve consistency and profitability with your trading. You don't just randomly go to your chart and identify any zones following the criteria I've shown you and you call them supply and demand zones. For a zone to be called an institutional supply and demand zones, it must have any of these 8 key areas. The first one being whether the zone breaks structure or not. This is the simplest and the most effective filter that you can use. It takes a amount of money to break structure on a liquid market, and the more significant the structure breaks, the more significant the zone is, which means it has more power to hold price. Swing structure will always be stronger than internal, while internal will always be stronger than fractal. These are things you learn on market structure. So zones that create swing structure, they are going to be the one that is more likely to cause another swing break of structure. Here is an example of a demand that you saw that create a swing break of structure, and when price return there, it's actually going to push more further to create another swing break of structure. The next zone is it a flip zone? And the key here is that you must see that interaction between supply and demand to see who has actually switched and who is in control. Here is an example on the chart where you will see a clear bearish order flow, and the price return to a supply, react from the supply and fail the supply, which means the supply have now switched and become a demand level, and you can see how the demand level or the demand order flow has continued, push it to the upside. Number 3 is sweep zones. These are actually zones that sweep liquidity. And why is this important? Institutions actually need this opposing liquidity in order to fuel the market to the in each other direction, and that is why it is very, very important. You always see it being formed, and then you identify most sell side liquidity below that level that is actually like a range, and when the market come now and strip now those sell side liquidity or those sell liquidity that are there, then it's actually going to fuel our price to the upside. So it is very important to include sweep zones in your institutional supply and demand criteria when actually looking at it. The fourth one being inducement. You always need to ask yourself that is this zone having inducement in front of it or not. If there is no inducement, then you should also wait for what they call pullback inducement to form. Why? Because institutions will actually need those levels to accumulate those liquidity to enter with minimal slippage. Just like how you will see this zone here, which actually has inducement. When the market return there, it is actually going to sweep that inducement, tap into the demand level and push to the upside, unlike a zone which does not have an inducement. When the market returns there, if there is no pullback inducement that has been built, the high of that zone is actually going to be used for the liquidity. Number 5 is the zone stack with another higher time frame. The more you can stack zones on 2 time frames or 3 time frames, the more orders are actually in that area. You can use this aspect to increase the confluence of your zone. Number 6 is actually if you have alignment on your higher time frame. The more alignment you have on your charts, the more probabilities your trade can go. If your higher time frame aligns with the lower time frame and the lower time frame also align with the medium time frame, the chances of the probability are in your favor that the market can always go in your direction as it increases the confluences. So aligning your time frames, making sure that higher time frame align, just like what you saw when we were doing fractal order flow or multi-time frame analysis, where we were aligning M5, M15 and H4, all of them aligning together. It actually increases the probability. So that's the same thing. When you be doing your supply and demand, always make sure that the demand zone on the 4-hour should also align with the zone on the 15-minute, and the zone on the 15-minute should also align with the zone on the 5-minute, depending on the type of trader you are. That's just an example I want to use. Here is an example of how higher time frame alignment will help you. If your M5 is bearish while your M15 is actually bullish, then you need to trade in favor of the M15 or wait for the M5 to switch, because if you try to trade against the M15, you're actually going to get smashed, just like what you have seen here. Understanding multi-time frame analysis will help you avoid a lot of losses in the market, as time is power and higher time frame always win. And this is what we have covered already on multi-time frame analysis. If you have not done that, you can also check that particular videos which I actually cover on multi-time frame analysis to better understand it. Number 7 is to ask yourself if the zone is well priced, because you want to be buying at the bottom of the discount range and you want to be selling at the top of the premium range. You literally want to be buying low and selling high. That sounds pretty cheap, but it is actually a lot of work to understand it, which we'll be covering in the future. So the best thing is to get yourself subscribed if you don't want to miss it. Now, last but not least is the zone unmitigated. This is a very, very important factor. You always need to ask yourself whether this zone you are trying to trade from, has it been tested somehow or it has not been tested. There's a chance that when price comes to zone that has not been tested, it is actually going to hold from there and go up, unlike when it is actually reacting from zones that has been tested. So this is a very, very key important thing. Joining all these informations like this is actually going to make a massive improvement in you actually spotting the right institutional demand and supply zones and deciding what particular zones to trade off from and which zones not to trade off from. You have actually learned numerous ways of identifying institutional supply and demand zones. Now, how can you trade from them? The first one is just by putting a limit order and waiting for price to return and trigger you into the zone. The second one is actually looking for a strong reversal candlestick pattern and you enter and continue with the move, or you actually look at a lower time frame structure shift. So these are the 3 key things or techniques you need in order to trade from your institutional supply and demand zones as a developing trader. Without any other things, adding any other things, you can still be able to trade using these criteria. We will actually cover liquidity, entries and management on the upcoming videos. So if you don't want to miss them, you should get yourself subscribed to the channel. And on my own opinion, the best way you can do to manage your trade, being it a developing trader, is to use a fixed risk to reward ratio and maybe target maybe a fixed hour using a set and forget management. But however, we're going to cover all those things in the future. So if you don't want to miss, if you get yourself subscribed, you can also join our free Telegram and WhatsApp and every group so that you can be benefiting from my free analysis I always share there. And if you want to get my private mentorship, you should also check out the link, the description of the video. You actually see a way on how to get to me.